This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to episode 20 of Value Investing. Over the last two episodes, we discussed how you can analyze bank stocks. In the first episode, I talked about bank business model, how they make money, what are the deposit structures that they have, and how you can analyze loan portfolio that bank manages. In the second episode, I talked about how you can analyze financial statements of a particular bank. And in this episode, I want to continue to talk about bank, and this is going to be the last episode that I talk about the bank analysis. And what I want to do here is to talk about how you can identify undervalued bank opportunities in the stock market. What I'm going to do is I'm going to go over 5 steps that you can take in order to identify undervalued banks. Before we get started, let me give you a disclaimer that this podcast is for entertainment purpose only. I'm not here to provide any advice to buy or sell certain market securities. It is your responsibility to consult with your investment professional for any investment decisions. Also, I want to mention that 5-star review always goes a long way on whichever platform you listen to your podcast. If you want to leave your comments or any feedback, please do so at valueinvesting.blueberry.net. Blueberry is spelled as BLUBRRY. Valueinvesting.blueberry.net. I read every comment and feedback and try to see them as my podcast improvement opportunities and incorporate them in the next episode that I record. So without further ado, why don't we get started? There are about 5,000 to 6,000 banks in the United States alone. Approximately 1,000 banks are listed as public companies. So when you're trying to find out undervalued opportunities in this area, and you might think that there's magic formula, but I'm not here to say that there's a magic formula that you can use and apply or plug that into algorithm in order to identify undervalued investment opportunities. Everything is case by case, and you might have to get your hands dirty and do your homework in order to truly find good investment opportunities. I just want to put it out there before I go into the 5 steps that I discuss how you can identify undervalued investment opportunities in the area of financial institutions. So with that said, I want to go over each step. The first step that you can do is get a list of banks from different websites. The first website that I recommend is FDIC website, where you can gather a lot of data for public and non-public banks. So if you go to their website, you can pull data relating to financial statements, and also you can gather a lot of non-financial data with respect to the bank that you might be interested in. I'll try to include a link in today's show note, which you can use to pull financial data, but my recommendation is just play around different options on that website, FDIC website, and see what data is available for many financial institutions in the United States. So once you have list of bank, the next thing that you have to do is obviously there are just so many banks. You have to screen out the banks that are not in your search category. What I mean by that is you have to identify only undervalued banks. So 2 metrics that I recommend to use is price to book and price to earning ratios. And this is really common valuation metric that we use for non-financial companies as well. But particularly in the case of banks, I think that these 2 ratios are highly important because it shows whether the bank is undervalued or overvalued. But let me say that these two metrics alone will not really give you certainty about whether or not the bank is undervalued. What I want to say is that this is a good starting point to find out undervalued banks. And this is just starting point. So once you narrow down the list, the next thing that you have to do is try to find out why the banks on your list have such a low valuation in terms of price to earning and price to book ratios. And there might be a good reason why they have such a low valuation. You can take a look at recent news articles and also take a look at other things. But it's probably due to their troubled assets and non-performing loans. If the company's asset quality is poor, then the valuation discount is most likely justified. If that's the case, you pass on this investment opportunity. For troubled assets, the bank may have a lot of foreclosed real estate assets. Or the bank can have investment securities such as bonds in its portfolio, and they might be suffering from some loss. So that's the troubled asset side. And the bank might have such a low valuation because it is due to troubled loans. If it's the case, you look at the loan portfolio and the composition of the loans and see what really caused the troubled loans. So you can look at the composition between residential and commercial loans and also try to identify risky loans that cause the trouble. The question that you have to ask to yourself is, what are the risky loans and how much portion do they account for the overall portfolio? And try to compare the risky loan level against peers. In the first episode, when I started to talk about this bank analysis, I mentioned that there are certain risky loans such as construction loans that can completely wipe out equity investors' capital. So you want to see how much loans are risky versus safe by looking at the composition of the portfolio. The other question that you have to ask to yourself, is this sustainable? The banks have to survive both good times and bad times. And if management is not prudent in terms of their risk management, the bank can wipe out the entire equity capital easily during bad times. An economy goes into good times and bad times, and there's a business cycle. You want to own a bank if bank has sound risk management system that can be sustained through good times and bad times. So we just talked about troubled assets and troubled loans, and I mentioned that these are two items that are likely to cause the low valuation. One thing to look at is the absolute level of these troubled assets and loans, and the other thing also you have to look at, which is more important, is the trend of these two items. So if the trend shows that the bank is getting more and more troubled assets and loans, then the bank might be in a serious trouble. Then you want to stay away from those banks even if the valuation seems to be low. However, the trend is favorable for the bank investors, then you may want to take this opportunity and invest your money in this area. Okay, so we talked about two steps so far. The first step is get a list of banks and try to narrow down the list by looking at price to earning and price to book ratio. And the second step is trying to understand why the banks are this undervalued category in terms of these two ratios, and try to understand troubled assets and loans and their trend over time. So once you go through these two steps, the next thing that you have to do, the third step, is to evaluate the level of capital that bank has. Remember, the capital exists to absorb losses potentially in the future. So if the capital is very high level, then even if you have troubled assets and loans, If the absolute level of capital is higher than travel assets and loan amounts, then the bank may be able to survive in the future by cleaning up its balance sheet and restart. In the first episode, when we discussed bank business model, I talked about common equity tier 1 capital, and total capital, and also talked about risk-weighted asset and different capital ratios. So what you want to do here is look at the absolute level of capital, let's say common equity tier 1 capital, and see if the absolute amount is way above troubled assets and loans. And the other thing also you can look at is reserve that the bank set aside on its balance sheet, because reserve will be hit first and then capital will be hit next in terms of loss absorption capacity. So once the bank has enough reserve and enough level of capital relative to troubled assets and loans, then as I mentioned, the bank might be able to survive bad times. So I just talked about absolute level of capital. The other thing that I also mentioned in the previous episode was that you have to look at common equity tier 1 ratio. You want to have this ratio at least 7%, and that actually is considered well-capitalized bank from investors' point of view. The fourth step that you have to take as an investor in order to identify undervalued investment opportunities is to analyze the financial statements. In the last episode, I discussed details of how you can analyze a bank financial statement, so I'm not going to go into the details or go over everything that I said in the last episode, but I want to touch upon certain points that I haven't mentioned in the last episode. The first thing is, if you look at the balance sheet, we extensively discuss asset side of the balance sheet. The other thing that I want to mention is the liability side of the balance sheet, and you want to look at the deposit structure of the bank that you're interested in and see if the bank has outside funding such as subordinated debt or FHLB loans. So when we discussed liability structure last time, we discussed deposit structure where the bank is getting money from individual depositors like you and me. Usually the cost of deposit is very low, so it's good for the bank. But if the bank is starting to borrow money from the public investors through issuing its own loans or getting money from other places that are high cost, then you might start to think that why it is the case. It might not necessarily be a bad sign, because the bank might try to rapidly grow its loan portfolio and trying to get low deposit as much as possible. And if they cannot do that, they can go to different funding source in order to satisfy the growth of the portfolio. But if it is not due to loan portfolio growth, and if they're having some troubles in order to attract deposits from individual depositors, then the bank might having some issues related to attracting fund for their business. Then if that's the case, then you may want to stay away from such banks, and because that could be an indication the bank doesn't have a strong deposit network. On the income statement side, many of the items there are linked to the balance sheet. I mentioned in the previous episode multiple times that the balance sheet is the key to analyze banks. And if you go to income statement side, for example, interest income is directly linked to loans on the asset side of the balance sheet, and interest expense is directly linked to deposit structure on the liability side of balance sheet. So since I discussed these items very detailed before, I want to move on to other items that I haven't got a chance to touch upon. The first one is non-interest income. So this is another source of revenue and income for the bank. And this item could be asset management, insurance, and investment banking, financial consulting. These are the businesses that bank might be engaged in order to make more money for bank investors. So try to compare the size of the income, non-interest income, against interest income just to see what business model the bank has. If the bank has a lot of income from this non-interest income side, then this is not traditional bank that you're looking at. So it's probably not apple to apple comparison if you're trying to compare the valuation of such bank against other traditional banks. The last item on the income statement side that I want to touch upon is non-interest expense. So these expense items come from usually employee salaries, IT expenses, and compliance cost. You want to make sure that the bank is operating efficiently compared to its peers within the same geographical area. So what you can do is use expense ratio and compare that against peers to make sure that the management is managing the bank in an efficient way. Once you go through this financial statement analysis, the final step that you have to perform in order to identify undervalued bank is to understand management team. The way you understand the management team is by looking at shareholder letter and try to see what they said in the past and if what they said is in line with the result over the last 2 or 3 years. So my recommendation is go back in time and look at shareholder letter that was published 2 or 3 years ago and look at the financial performance of the last 2 years to see if what they said truly is consistent with what really happened in the past 2 years. So we talked about 5 steps today. The first step is to get a list of banks from FDIC website or some other websites and try to screen out the banks that are highly valued by looking at price to earning and price to book ratio. The second step is trying to understand why the bank stocks are undervalued in terms of those two ratios and compare that against peers. And try to understand troubled assets and troubled loans because those are the areas of focus for a lot of investors. And probably those are the areas that caused undervaluation. The third step that I mentioned is look at the level of capital and make sure that the bank has high level of capital relative to troubled assets and loans. And here I mentioned about another item on the balance sheet, a loan reserve, because that's the item that's going to be hit first and then capital will be hit next in terms of loss. The first step is analyzing financial statements. And final step is understand the management, whether they're honest and competent by looking at shareholder letter 2 years and 3 years back and make sure that what they said is what really happened over the last 2 years. I know this is a lot of steps to go through and you really need to get your hands dirty and do your homework in order to truly identify good undervalued investment opportunities. And there's just a lot of data available for a bank by going to SEC website or FDIC website. And there are a bunch of news articles relating to public companies. So what you need to do is focus on material items that truly matter to the bank's success in the future. Because if you just try to understand all little single details, you're not going to really have time to identify good opportunities. So your goal should be try to screen out as many banks as possible through all these 5 different steps in order to spend your time on just several banks to have a better understanding on them and see if you can invest your money. And your goal is identify 3 or 4 banks that are truly undervalued compared to its peers and invest your money there, not to understand the entire universe of banks. Okay, that's it for today's episode. I hope you enjoyed the 3 episodes that I put together for the bank analysis. And as I mentioned in the previous episode, this is the area that not a lot of people understand fully. So you maybe have a better chance to find out undervalued opportunities because of low competition. And also you can expand your investment search if you know how to analyze a bank. So it's a good study material, and I hope that you really go through and review the materials that we have discussed on this podcast. And just practice by just simply taking one bank as an example and try to understand the bank by going through balance sheet, income statement, and understand the business model by looking at deposit structure and loan portfolio, and also try to look at shareholder letter from the management team and see if what they said is in line with what really happened in the past. So there are just many different steps you can take in order to have a good understanding of a bank, and I think that's going to be a good exercise for you if you haven't really known this area before. I hope you enjoyed these 3 episodes, and before I end, I just want to mention that a lot of ideas from these 3 episodes were from a book called The Bank Investor's Handbook. I'll just try to put a link in the show note to which you can go and buy a book if you're interested in. Thank you very much, and see you next time.